Okay, so in this one, we are analyzing a specialized printing business. This is another deal analysis video we're going to do to help you understand how to finance business acquisitions using other people's money, right? How do you buy businesses without using your own money or using a small percentage of the total purchase price as a down payment? Let's talk about it. Okay, so here we have a specialized printing company for sale. This is right here on BizBuy for Sale or bizbuysell.com. Admittedly, you're not going to find the best deal flow on the planet on this platform because they're open deals. The best deals are going to be found off market or with brokers or investment bankers who give you pocket listings, aka the deals they don't take to the open market. But this still gives us a great opportunity to analyze how to structure a deal to get it done. For this one, they are asking 3.85 million. You see that there. Okay, they're not giving us a lot of information. They're not giving us the gross revenue here. Okay, so we don't know how much in sales they're doing per year. They're saying the EBITDA, a phrase I candidly hate. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. I recommend you watch Warren Buffett and Charlie Munger's video on EBITDA. Okay, but EBITDA essentially, roughly speaking, means bottom line profit. And that is the number they are saying that this business is taking to the bottom. Take that evaluation with a grain of salt, but we digress. And they're saying the cash flow, which is another variable that, or another metric that is a little questionable, but they're saying the business is cash flowing 863,000 a year. And they're going to describe that here and you can read their little analysis, but candidly, it's probably a bunch of gobbledygook. Okay. This is why you have to do diligence. But the punchline is you have a business opportunity here. They say they have 11 employees. All right. The seller says he wants to retire. You see that there, this information here. Great. Let's get into the analysis. Okay. So here we have a very basic financial calculator. I've taken a lot of information out of this, and you can look at my YouTube channel for other financial calculators that are a little more built out. I cut this one into the very basic bare bones, however, because I don't have a lot of data, right? All I really have is the cash flow that they're saying the business produces on an annualized basis. And then I have the asking price. Okay. We're going to run this financial model, assuming we're willing to pay full price, but with a certain deal structure that I propose below. And we're going to make the assumption that the given cash flow is correct. Okay. The asking multiple here, which I'm going to put in bright green, per this is about 4.46 times earnings. How did I get that? Real simple. I took the asking purchase price divided by the annualized cash flow, and that equals 4.46. Let's get into the financing assumptions. Let's talk about actually potentially doing this deal. Okay, first of all, you'll see the SBA 7A. That is the preferred loan product for doing business acquisitions up to $5 million in the United States. The reason? Simple. It is government-backed finance, and it's the easiest finance you're going to secure in the marketplace. Period. End of story. There's not even a question. Okay. You will have to personally guarantee if you own over 20% of the shares, assuming you do an asset purchase agreement. And that's basically that. Let's get into it. Okay. First things first. I am making the assumption that we are going to borrow about 3.08, so about $3,080,000 to buy this business. I put in 80% of the purchase price will be coming from an SBA 7A loan. Okay, and that's how we got this here. I'm real simple formula. I just take the purchase price, multiply it by 0.8. I put in the 120 month amortization schedule. It amortizes over 10 years. An SBA 7A loan does. I put a 10% interest rate, given that we're in a higher interest rate environment, given the fight that the Fed is fighting against inflation. And that's that. Okay, your monthly payment is going to be $40,000 in change per month. Next, I then recommend a seller finance loan, and that's really what this stands for here. Let me write this out. I really recommend you put a second position seller finance note or a second position seller finance loan into basically all SBA deals. What does second position mean? It means that the seller has a subordinated loan, which ultimately means if you bankrupt as the buyer, that the lender, the SBA 7A lender, gets the first lien rights on any and all assets and collateral for the business to repay the first position loan, the SBA loan. And then if there's anything left over after you repay your loan, then the second position lender gets access to the remaining collateral. Okay, so it's a riskier position to be in the second position than a first position, but nevertheless, here we are. And I worked in the assumption here that 20% of the purchase price is going to come from a second position seller finance loan. I put her on 180 months, which is a 15-year amortization schedule. I put it at a 10% rate as well. You could either have this be fully amortizing, which means you're going to have the ability to make payments for the full 180-month period, or you could put it on a balloon where you amortize it, say, over 180 months, but then say after 60 months, you have a balloon whereby, so after 5 years, you would have to make the payment in full or refinance the loan. I talk more about balloons and terms and all of these financial constructs on my YouTube channel. If you're not here already, subscribe so I can continue to share this kind of content with you to help you buy businesses using other people's money, or using a little bit of your own money in the balance through SBA finance, commercial finance, seller finance, etc. But this is what I would do so far. I would get 80% of the money from the SBA 7A. I would get 20% from a second position seller finance loan. This is what I would try to negotiate with a seller. I would then make sure I brought working capital to the table. Y'all have perhaps heard my story where I've made a couple of mistakes in my deal-making career, one of which was not bringing enough working capital to the first acquisition I made in the utility sector, and it almost cost me badly. So I would recommend you bring sufficient working capital. Now, how much working capital do you need? You're going to have to analyze the receivables, the payables, the cash flow cycle, all that good stuff to really get a strong sense. But I just made the assumption that 10% of the purchase price you want to have in working capital, which in this case is $385,000. Okay, now I recommend you roll in your working capital loan with your base SBA 7A loan. You can do it. This is how you're going to get the working capital loan to keep the same terms as your SBA 7A loan. Take it from me, I made this mistake in the past. If you don't work in the working capital alongside your main acquisition loan, then this the months that the loan amortizes over will get cut down to something like 96 or even 72. And look at the effect this has on the payment. Look at the payment over here at 7,100 when it's amortized over 72 months. Now watch that payment when it goes to 96 months, goes down to 5,800. See that? And when it then goes all the way to 120 months, watch that monthly payment on the right-hand side. Notice how your monthly payment continues to go down if you amortize it over a longer period of time. Now, as you amortize over a longer period of time, you will ultimately make more interest payments. But usually, if you're bootstrapping your first acquisition, I'm a believer that you should try to keep your monthly payments as low as possible to make sure you are able to stabilize the business that you're acquiring. And then once you get into it for a year or 3, if you want to make larger payments against principal, if you want to refinance the loan for a shorter amortizing schedule, you can do those kinds of things. But I'm about keeping your monthly payments as low as possible on the onset, to help you make sure that you're able to handle the deal after you buy it. Okay, so we have our monthly payments here that are accrued. But before we go into calculating our cumulative cost of debt, first let's talk about the equity injection. Okay, this needs to be cash. It has to be cash, but it doesn't have to be your own cash. You can give an equity arbitrage to an investor. This could be a high net worth individual. It could be a family member. It could be a friend. It could be, somebody that you reach out to on LinkedIn. There's a lot of ways to find investors. I've talked about this a lot. You can search my video on YouTube, how to raise private equity or private investment. And I have a video that really breaks down how I recommend you do this. And I can make more content on this as well if you would like. But you have to have 5% of the purchase price in cash in an SBA deal. It's a non-negotiable at the current moment, and it doesn't look like that's going to change anytime soon. So do expect to bring 5% of the purchase price in cash. In this case, it's $192,000. The reason I don't have a monthly payment here is because this is equity. You cannot make guaranteed payments on equity. It's a violation of an SBA loan. Thus, you need to keep from making an obligation as far as the monthly payment. Right, so this is on investor. No required payments are allowed. That's what makes equity in the eyes of the SBA. Lastly, and this is another one that's important, the seller finance equity injection. This can be the other 5% of the purchase price, right? So you have 5% of the purchase price is going to come in cash. The other 5% is going to come from a seller finance equity injection. And this in combination makes up 10% of the purchase price, which is the minimum equity injection required for an SBA loan. Now, what I always write is, on hold. I need to reduce the size of the font, but let me basically tell you how to write this up because a lot of people have questions about this. On hold for the life of the first position SBA loan to then subsequently be repaid on, say, a 36-month fully amortizing loan at a 6% annual interest rate. Interest does not accrue until the first position SBA loan is paid off. Okay, that right there, my friends, is how you get the seller to contribute. That didn't quite work out the way I wanted it to, but you can read it here. On hold for the life of the first position SBA loan to then be subsequently repaid on a 36-month fully amortizing loan, say at a 6% interest rate. Interest does not accrue until the first position SBA loan is paid off in full. Swing, that is how you write it up, okay? And that's your capital stack. Now, we're going to work through the rest of this spreadsheet, and then we're going to see if this deal works. First, the monthly payments here, I simply combine them and take that down here to the projected, and this should really just be the projected debt cost. Okay, so our monthly debt cost here is the summation of these three notes, if you will, $54,000 a month. When annualized, it's simply multiplying that number by 12. Pretty simple, $648,000 a year. Okay, by the way, some SBA loans are variable. So you want to make sure that between your interest rate variability, that could be a factor, as well as how well the business is going to perform, that you have some cushion in your deal. So let's see if there's enough cushion in this deal. So we scroll down. We go to the projected cash flow analysis. And this is where the rubber hits the road. Let's even zoom in a little bit here so we can really see what's going on, okay? So here we go. Let's get into it. First thing we have here, as soon as this screen will bounce over, here we go, is we have the projected cash flow in a worst case scenario. And I always like looking at this from a worst case, a base case, and then a best case scenario. Okay, it's important to do this, in my opinion, for your deals and to really try to push on the worst case scenario and see if your deal can survive. In this example, I worked a worst case scenario at 70% of that given cash flow that's right here, the 863,000 you see that's highlighted. I'm saying 70% of that number is my worst case. But to be honest, let's push it even further and say 50% is the worst case. Okay, in that example, look at what my projected free cash flow is, and that's what FCF stands for, free cash flow. Okay, and I should put after debt. Use the lack of spaces. Okay, so here what we're really seeing is if we only do 50% of what's projected in the first year, see that given cash flow number here, the 863 grand. If we only do half that in the first year or in any given year, we are basically going to lose $217,000 a year. Not very good. We would only have 66% coverage of our debt. We're basically losing, anytime your DSCR is under 100, you are underwater. You're underwater. Okay, base case is the number we were given above, 863,000. In this example, we would have a projected free cash flow after debt service at base case of 214,000 left over. Okay, and all this really is taking your projected free cash flow, the 863, minusing it from your annualized debt cost, and there's your 214,000. You have 133% DSCR. Not great for a base case. If your base case DSCR isn't about 150% or better, especially for a smaller SBA deal, not very good. As of right now, I don't know that a lender would sign off on this deal as currently constructed. Okay, our best case I ran at saying it's 40% better. You can see that in the top left-hand corner, 40% better than the number we were given, which is 1.2 million. Okay, there we have a little bit of a better look here. We have almost 600,000 in projected free cash flow after debt service, 186% DSCR. That works. I mean, if you achieved a best case scenario, if you did 40% better than, you know, the number they gave you as far as cash flow, then you'd actually have a pretty decent thing. But this is not a world-class deal right now. So let's play around a little bit more. Let's have some fun now. Let's say we do this analysis and we say, do you know what? I know they're asking for 3.85, but why don't we offer them 3.1? Not 310,000. They'll definitely not accept 310,000. But let's say we're going to offer them 3.1 million. Okay. What I want us to do now is look at how big of an impact this has. Now, first of all, because I used a percentage for all of these, except for this one, which I blew out the formula for that. But now what we did is we made all of these ratios. And this is why I love using ratios for these calculators. It allows you, and if you want to make a whole bunch of different tabs, what you can also do, by the way, and I'm going to create a new tab here. One sec. And this is really a nice thing. This allows for some great analysis. Okay, so this is going to be our $3.1 million offer tab. And this first tab is going to be our 3.8 million offer. Because what I'm going to do real quick is I'm going to put this back to 3.8. We saw that analysis. We just went through that analysis. See how my numbers repopulate immediately, which is nice, except for this one, which I'm going to make back to the right formula. We want purchase price times 0.05, right? Because we're always going to contribute 5% of the purchase price in cash and then 5% on a seller finance equity injection, okay? But now this is our $3.8 million analysis. And you saw these numbers. We went through all this. This should look obviously very familiar. But now what we're going to do is we're going to take the sheet, we're going to copy it. On the Mac, it's Command-C, or I guess you can just press copy, okay? Give me 1 second here. It gets a little sticky when you start copying these big sheets here, but the computer's working and we're working and it's about to copy. We have another tab. And what we're going to do is we're going to run the analysis for 3.1 million now. And watch the difference between 3.8, which we have over here on the first tab, versus 3.1. Okay, at 3.8, we're paying over 4.4 times earnings. Okay, we're paying 4.4 times earnings plus. When we go back to the $3.1 million offer now, we're paying really more like 3.6 times earnings. That's a lot more attractive. Our debt burden now is only a little over 500 grand, whereas before it was well over 600 grand. Our monthly payment is down to 43,000 a month. Okay, our SBA loan in the first example was over 3 million. Now it's at 2.48. Okay, so that brings all the payments down. Yet our free cash flow projections are the same. So now we're looking a little better. At base case, we're looking at 165% DSCR. That's a lot better. Is it world class? No, but it's better. Our worst case projection, though, admittedly, I made this very brutal. I mean, I'm talking about a 50% nosedive from year over year. There, we're still not at 100% coverage, but at least if we just bled dry, we still bleed less than 100 grand a year. Bleeding less than 100 grand in a terrible, terrible year is a lot better than bleeding, basically a $250,000, which is what we saw on the prior sheet. Okay, so this is a lot closer to where I think you can dance. Now, real quickly, I'd love to be paying about here. This is where if I were trying to do my first deal, I would try to land it around here at about 2.5 million. Okay, and look at the difference when we get down to the $2.5 million offer. Now our asking multiple is 2.9 times earnings. Our SBA loan is 2 million even, way down from over 3 million that it was at the $3.8 million offer. Now we're at 2 million even. Again, these formulas populate automatically because I just use a ratio. I'm saying 80% is going to come from the SBA 7A. Okay, 10% of the purchase price is going to be working capital. My seller finance loan is going to be 20%. All of these fill in real nicely here with this sheet. It's fantastic. Now my annualized debt burden is $421,000, way down from the over $600,000 annualized debt burden I had when I was going to pay 3.8. Okay, so what does this look like now down over here? This is where you really have a strong deal. Even my worst case scenario, where I have 50% just financial ruin of the business in an annual fiscally in a year, in a financial year, we still, I mean, it's nothing to be proud of, but you're still free cash flowing $10,000 when you lose 50% of the business, okay, for a 102% DSCR. At base case, which a lot of lenders are going to analyze, your DSCR is over 200% now. It's at 205%. And then best case is fantastic. You're almost at 300%. This is a deal you would like to do. This deal makes sense at 2.5. At 3.8, I don't think it makes much sense unless you want to kick in a lot more cash, okay? But if you're trying to finance this using basically other people's money in its entirety, or massive amounts of other people's money, the vast majority of the purchase price in other people's money, then I think about 2.5 for a deal like this, where it's doing about 863,000 a year in cash flow. This is about the right play. For SBA deals, especially with a higher interest rate environment, I'd really be trying to stay right here at about 3 times earnings. When you get over 4, I mean, let's go back to the initial model. You see this at 2.9 versus 4.4, and you see the difference. Okay, you saw the difference. Look at worst case here, man. You're bleeding over 200 grand a year if you have a real problem in the business. And even at base case, you're only getting 134% DSCR. That lender wants to see base case DSCR at above 150. They like $1.75 to 200. If base case DSCR, in other words, what the legitimate, reasonable projections are for annualized free cash flow, if you can get that DSCR to over 200%, you have a really strong deal. The lender's going to love it. All right, so that's it for this one. If you've liked this one, thumbs it up. Subscribe to the YouTube channel for more M&A, financing, and business content like this, and I'll talk to you in the next video.